Most entrepreneurs are exactly one lawsuit away from losing their house, even with an LLC. If you were sued right now, what could they actually take? Most of you believe your LLC is a fortress, but the truth is, for many businesses, it's a paper-thin screen. And in this episode, I'm showing you the $10,000 mistake your insurance won't cover. We're talking about why forming an LLC is not the same thing as creating separation. If your LLC leaks, no amount of business credit, tax strategy, or funding hacks is going to save you. This is the single entity trap. The biggest mistake entrepreneurs make is believing the LLC itself is the protection. It's not. The LLC is only a container, and most business owners never separate what's inside the container. They put the operations, the money, the contracts, the equipment, intellectual property, and the risk all inside one entity. So when pressure hits, everything gets hit at once. It's like plugging your entire house into one extension cord and then acting shocked when one short circuit shuts everything down. The LLC didn't fail. You just connected everything to the same place. At the core, the LLC was designed for one purpose: asset decoupling. It's accomplished by creating a legal person separate from you. Meaning, if the business gets sued, the liability is supposed to stop at the company, not at your house, your savings, your paycheck, personal assets. That's the theory anyway. But theory and behavior are not the same thing. Most entrepreneurs form the entity, but continue operating exactly the same way they operated before in their personal lives. You bought the safe, but left the cash sitting outside. So the safe didn't fail. You simply never used it correctly. So much time is spent talking about personal liability that most entrepreneurs forget something very important, and that is the business assets themselves are exposed. When an LLC gets sued, the assets inside the LLC become reachable. Operating cash, equipment, inventory, receivables, trademarks, even the brand itself. So if all your value sits inside one operating entity, you didn't create protection. You created a basket and placed every egg inside it. One slip, one dispute, one judgment, and boom, the basket flips. This is where the conversation gets dangerous, because entrepreneurs hear phrases like corporate veil and assume the veil protects itself automatically. It doesn't. The shield only exists if the behavior supports separation. If the business becomes your alter ego, then the shield weakens. And if a court concludes that the company is really just an extension of you, the separation starts collapsing. It's like you changed the name on the building, but never changed who was really living inside. So when the pressure arrives, the institutions follow behavior, not the label. There are patterns that the institutions look for: commingling, that's owner dependency, poor capitalization, personal guarantees. And every one of those behaviors sends a signal. Commingling says you pay personal expenses from the business account. The signal: no separation. Undercapitalization says the company never has enough money to survive independently. That signal says the business was never intended to stand on its own. And personal guarantees, you sign personally. That signal says the bank still trusts you more than the company. And once enough of those signals accumulate, the structure starts collapsing back toward the owner. This is why one LLC is often not enough. Real separation requires layering, not one box, a system. One entity to handle operations, one entity to hold assets, and exposure stays where exposure belongs. Think about a ship. If one compartment floods, the whole ship shouldn't sink. That's the purpose of containment. Pressure in one place shouldn't automatically destroy everything else. This conversation is really about something deeper. Structural literacy. This is for the pro sepreneur. That's the entrepreneur who refuses to remain structurally illiterate about the systems affecting the outcome of his or her business. Because once you understand structure, you stop asking, how do I form an LLC? And start asking, what actually separates the risk? And if you recognize yourself somewhere in this episode, it's not a failure. That's awareness. But awareness alone changes nothing. If you want to understand whether your structure is actually separate, where exposure may already exist, or whether your business is drifting back towards owner dependency, then there's a structured way to evaluate that. The link is below in the description. And now, watch the next episode. The 3 things that actually protect you, not your LLC or your corporation, because that's where we move from identifying the exposure to understanding what actually creates separation. Because the real question is not whether you formed the LLC. The real question is whether the business ever truly became separate from you. If this gave you a different way to think about your structure, then like the video and subscribe, because most of what's out there is focused on formation, not what actually holds under review. And if you're already operating a business, then there's a free resource in the description called the Structural Exposure Check. It's a simple way to see whether your business is actually separate or just documented that way. And remember, structure isn't what you file. It's what survives under pressure.